We're going to be discussing matters of money, and not just money in the usual way, but talking about mobile loans. How many of you have taken mobile loans? There are so many apps and platforms where you can take mobile loans. Some are offshoots of some of the existing financial service providers, and some are just independent financial service providers through various apps. And the question is, are you sure you're actually taking enough? Or you're taking more than you can handle, because that's what's happening. And I've got a panel in studio. I'm joined by Phyllis Kamau, who's an advocate of the High Court, and she's a corporate, commercial, and regulatory policy lawyer. We also have Robert Masinde, who's the country manager of Zenka Finance Kenya, and Derek Kiea, who's an investments analyst at Saiton Investments. Thank you for joining us. Now, let's just begin with, for the sake of context, to understand where are we with this betting. And just before the show began, we were talking a bit about the different figures about how many people are taking loans online. So I'll begin with Derek, because I think you guys have quite some of those numbers as Saiton. Like, where are we in terms of how many people are taking loans and the likes? And then I guess even Phyllis can jump in after that.
All right, thank you. The issue of digital lending or mobile loans, it's a bit recent, came around about 5 years ago. This has mostly been driven by the interest rate caps that were brought about on our banks. They were capped at 4% above, no more than 4% above the CBI rate. So with this, banks were forced to do away from the risky lending to the common mananchi. And you can see, based on the statistics, then you see credit extension to the private sector went down. And at this point is where we saw all these unregulated digital lending platforms coming in. And as at now, you can see the numbers have grown exponentially. As per the report we were discussing earlier, we see there are about 7 million active borrowers. And of this, you see most of these 7 million are most claim to have borrowed on more than 10 platforms. So I think that is where we are right now.
So people have borrowed on so many platforms. And I want to bring in Robert, because you guys offer the service. So for instance, I've borrowed from his app, through her app, and then I come to yours. Is there any kind of information sharing, or is it only at the point when I'll be listed on CRB that I actually know that I'm in trouble?
Actually, you bring in a valid point. The issue of a borrowing is a concern even for us as lenders. And one of the things that we want to enforce in the industry is effective information sharing. So part of doing that is going through the CRBs. And almost all digital lenders who come into the market who want to seriously develop a viable product are part of the CRB information sharing system. What we want to do, however, is to improve it so that it can be more current, because as we have seen, a lot of how the CRBs were set up was fashioned to serve the banks back then. So the kind of data that the banks share, their frequency, the volume, is quite different from what the digital lenders want to share. And the format is also different. So we are in the process of trying to improve that. And it's not perfect, but it's getting there. Because it's in the interest of the lender to ensure that whoever he's lending to is able to pay. At the end of the day, it is the lender's capital that is at risk. And so to answer your question, we have started the process. It's not perfect, and we are working on improving that as we go.
I want to bring in the lawyer.
Yes.
Are we seeing a regulatory loophole here?
Yes. First of all, I would want to clarify this. The growth in digital lending has been a deliberate result of government policy to drive financial inclusion and extension of digital services. If you look at the policy of the government from the MTP3 on financial services, there's been a deliberate support both from Treasury and the ICT Ministry to drive ICT and adoption of technology to revolutionize financial services. And if you see how Kenyans have taken up into digital platforms to borrow credit, you can see they are being driven by the convenience, the opportunity, the privacy, the availability. And some of these consumers would never have accessed loans from the traditional lenders. And this is a very good opportunity. We've been able to entrench and bring these people within credit financing. Besides that, I think it is also not very accurate to say there is no legislation. There is legislation. The way the current financial market, credit market is structured in Kenya, there are deposit-taking institutions and non-deposit-taking institutions. So the policy of the government has been to heavily regulate deposit-taking institutions. We have CBK, we have the Microfinance Act that regulates deposit-taking microfinance institutions. And the policy was that and you know, since 2006 when they put in place the Microfinance Act, the government did not regulate credit-only lenders. These are lenders who just come into the market and lend their own money. This is not public money. They're not taking money from the public. And Section 3 of the Microfinance Act actually allows the Minister in charge of Treasury to put up regulations for credit-only microfinance institutions to regulate certain aspects of the lending. I think where we've arrived, after 5 years of growth in digital lending, we are getting to a point where certain policy issues are arising. And regulation always follows innovation, you know, because you let innovation to grow and then you start to ask yourself, what are the issues in the market? What are the issues for the consumers so that we begin to regulate? And I think where we are in a very good place where both policymakers, industry players are looking at the issues and asking them, what are the issues that we can address? But for the consumer, I think we've come to a point where the consumer is enjoying services, is enjoying the ability to borrow from various platforms, and they can engage and they can make a decision where to borrow. We're also looking at a borrower right now who, because of the entrenchment of these services, now understands financial credit. They can access as little as 50 shillings, 100 shillings, up to and grow their financial credit to be able to loan, to borrow more amounts. So as policy makers, I think it is important that we all come together and discuss how do we then put up policies that are still going to drive innovation.
Okay, and excuse me, and one of the concerns that comes about is with like many other products, the fine print. Mm-hmm. There's the things that people don't read down there, and that is what ends up, you know, just eating you up. So I want to bring back, sorry, Derek.
Yes.
What are some of the things that we see people defaulting on? And I think also Robert will respond to this. So what are some of the things that, you know, the guys who borrow through the apps find themselves having been overtaken by, so to speak?
I think in as much as she mentioned this regulation, there's also loopholes, and I believe there are quite many. You can see banks are not allowed, as of now, they're not allowed to lend at more than 13% interest per annum. That this, if you look at how they're dispersing via their apps monthly.
Okay. Sorry, let me just interrupt you for just a bit. Before we get back to Mombasa, let's come back to our discussion in studio. And I cut you short, Derek, sorry. Maybe you could pick up from where you were.
Okay, as I was saying, in as much as regulation is there to protect the consumers, I think education should play a bigger part. This comes in two ways. The terms and conditions of your loans and the consequences of your lack of honoring the terms and conditions. So CBK comes in and says you are not allowed, it tells the banks you're not allowed to give loans at more than 13%. The bank says, okay, if we are going to loan out at on monthly basis, this sums up to no more than just above 1%. But if you look at how these banks are lending, they tell you, yes, we'll give you 5,000, interest rate is at 1%. We are going to give you we are going to deduct a 5% processing fee, a 5% rollover fee if the loan carries on into the next month, and so on and so forth. So even if we say yes, there is regulation and the regulation is trying to protect our consumers, I think education should play a bigger part. Now going to the second part of the consequences of the fallout of your lack of honoring the obligation, quoting a statistic that was done from a survey that was done by FSD in around 2017, they gave around 500,000 people who have been blacklisted for defaulting. And I can bet you that majority of these people do not know the consequences of this, and I'm sure in the long run, this is going to come and haunt them.
Okay, maybe you could pick up on that.
Yes, that's a very important point that's been raised, because we as digital lenders grapple every day with the task and the prioritization that we need to give to educating our users. I think in the long run, if it works for them, it works for us. I think that's the basic mantra that most of us have. And however, to enforce this, to put this into practice, we at Zenka have joined up with other digital lenders to form a Digital Lenders Association of Kenya. This is one of those forums which was lacking before to address the industry-wide issues such as user literacy and creating a certain minimum standard among all the players. So as he has mentioned, there could be regulation, but regulation doesn't always cover everything. I think there has to be a concerted effort and very deliberate initiative among the key stakeholders, in this case being we, the digital lenders, who are the ones who put in the investment, to ensure that the user, who is the person that we are serving, comes out of this on top. So part of the things that we are doing to enforce user education and knowledge ahead of them taking into this obligation. First, let me clarify that, you see, it's a loan obligation like any other, It's just that it's transmitted through an electronic channel that has made it sometimes look different, but the obligations of the borrower and the lender are pretty much similar to any loan obligation. I think what happens here is that because of the expediency of delivering this service, once you deliver this service with efficiency, real-time, online, instantly, sometimes the focus on the terms and conditions and the underlying terms gets overlooked. So one of the things we are doing as an association is to try and create a minimum standard, whereby we say for all our members, let's have a minimum standard of transparency, particularly around pricing, particularly around affordability for the borrower. And affordability means will you be able to pay at the time you're supposed to pay.
And speaking of that, what are the rates we're looking at here? Is it still under the same rate capping law, or is yours a different case?
Well, the rate capping law applied very specifically to the banking sector. So if you're licensed and regulated by the central bank, then that cap came into play and it has been enforced. We are not regulated under the Banking Act, so it doesn't apply to us. And I think the general approach by the policymakers and the regulators is that where you're lending your own funds and you're not taking deposits from the public, the approach so far has been they don't regulate, okay? So because of that, it becomes a private treaty between lender and borrower. And so that's determined very widely. There's no standard rate. It's determined very widely depending on, first of all, the digital lender, the person's credit rating, the tenor at which they're going to borrow, and also the kind of service that the digital lender is offering, which then also translates into the cost of that borrowing. So it is a wide range, and there are now more than 40, so I wouldn't be able to
So what are the ranges we are seeing interest rates? I mean,
you have seen that in recent past, I think it's only digital loans where you have had, where you have found them offering rates as low as 0. I think you've heard that. There's been a promotion where there was...
As an offer.
As an offer.
Yes.
So they can go as low as 0. They can go as high as 30%, depending on what the product is. So it is not standard, and it's impossible to standardize it.
Just to add on this, I think it's very important for us to state that last week the court made a decision regarding the Section 33B of the Banking Act. And if you look at that decision, the court was really saying there wasn't a lot of, the section itself was ambiguous, did not have a lot of clarity on how it applies, and that is why it was set aside. And one of the things the court was saying is the issue, how do we arrive at what a credit rate, how do we arrive at the credit rates that lenders should lend on, okay? Part of it, Parliament thought it was interest capping, but after they imposed the interest capping, we saw how that is now affecting the market. And what the court has done is it has allowed a period of 12 months for the policymakers, both Parliament and Treasury and CBK, to come together and stakeholders and for me, really, it has got to be based on research. It has got to be based on data to determine how do we arrive at interest rates. You see, digital lending, credit-only lenders face a lot of risks. The risk is high because you don't know this customer. Remember, the lending is done automatically. You don't have any customer facing. The guy could even throw away their SIM card, and that was, you know, when it started in 2017, that was prevalent. Fraud is a big issue,
yes,
where people borrow and throw away their cards, not thinking their obligations will follow them. And because of that risk, then they price their rates accordingly, and that is why, you know, credit scoring is important. That if a customer's credit scoring is good, if they are a repeat customer, then their rate would come down. So as to what this rate should be, as to how it should come down, I think it's where we need a framework. And I was saying, as much as there is maybe fragmented regulation, that the industry is just not operating like a Shylock. I mean, the industry, because they're operating on a mobile platform, the mobile platforms are regulated under the National Payment System and with CA. Okay, some of the players at banks, they are regulated within the Banking Act. Okay, some of them are microfinances, they are regulated under the Microfinance Act. So there are bits and bits of fragmented regulation, and perhaps the regulator may now come together and look at now this group of credit-only lenders, and there are certain aspects of regulation that can start. In my view, we could begin with prudential guidelines where we start to look at these credit-only lenders and ask ourselves, who are they? Where are they getting their money? What is their governance structure? Because that is the concern also of the regulator. And then in terms of consumer, what are the issues for the consumer? He mentioned transparency when they are coming into the contract, that they need to know the rates. Okay, that has been clearly pronounced by the Competition Authority. They pronounced that mobile services, the rates and pricing must be declared to the customer. And so perhaps then that is now to be extended to, and I think by extension it does apply to the credit lenders, the app lenders, but it's not, you know, defined in one law. Okay, and then we can look at other aspects of transparency of these credit lenders. Who are they? Where are they getting their money? Who are these people? Because again, you want to have good people investing into this industry so that they don't exploit the customer. Because at the end, if you do have a group of people that have a certain value, then you would expect that the market conduct will be good. Again, as Robert said, self-regulation is important, that the industry can start coming together and having certain standards that are acceptable in the market. The other issue, of course, is on pricing. But as we said, I think now it's a very good time for both policymakers to come and do proper research to back up policy on credit rates and the pricing that should be there, so that we do not exclude a certain group of Kenyans and make it impossible for them to access credit because of certain policies that we can take. And as he rightly said, because of the decision by Parliament to regulate interest rates, the low-end SMEs were cut out from banking because banks were deeming them too risky. Yes. Okay, then the digital lenders have taken up that risk to lend to these people, and they are pricing their loans a bit higher because of the risk they have to bear. Okay, so if this person is providing this service at this interest rate, and the customer understands his obligation and is willing to take up the service, then you see the problem is resolved. Part of it is also consumer information. I think financial literacy is important, and both stakeholders should work to
a number of times you find the communication still has a lot of jargon, so yes, the common mwananchi may not really understand what they get themselves into. And I think there is need, and I think actually by the common mwananchi taking up this service, they're also increasing their financial literacy. For instance, many of them did not know about CRB. They thought you could throw away your SIM card and you disappear in the clouds. But now they know that your history follows you because of your ID. When you borrow, what is listed is your ID number and not your line. So when you take another line, your record will follow you. And now if they start understanding how to get themselves out of listing, remember, listing doesn't even happen automatically. It takes 90 days of a non-performing loan before you actually get listed. Yes. And so borrowers need to understand, when you take a mobile loan, yeah, you have the period to repay. If you can't repay it like in a month, you have like 90 days to repay it. And even when your loan becomes bad, you can still go back to the person who listed you and negotiate for delisting or for your credit score to change. So you can still repay it.
and then come to a positive rating, and you are able to borrow again.
Okay.
Yes.
I just wanted to add that, you know, in any time when there's a new innovation coming into the market, I think it's inevitable that for some time, a few hazards will emerge. And the danger sometimes is to focus a lot on only those hazards and disregard the general good that has been created. So for instance, the numbers being shown right now, my colleague mentioned 500,000 people listed at CRB. But if you take that in proportion to 7 million users, you realize it's not, you know, proportionately significant, right? And then you also have to remember that that number is largely amounts of about 200, 300. So if you take the value, it's actually even less. It's probably less than 1%. So it's true that there have been more listings on CRB in terms of individuals, but at the same time, we should remember that what is happening here is that these people initially had no credit access. They're having their first encounter with the experience of borrowing and repaying. The other thing that I think that needs to be emphasized on also is that reporting to CRB is both negative and positive. So many of them, the 500,000 who have defaulted, still have a chance of repaying, getting out of that situation, and carrying on. They'll have learned a very vital lesson. When they start borrowing more and they graduate to borrowing from a bank, they'll be better placed, you know. So, but the other sort of 95% or so who are borrowing, when we report to CRB, we also give positive reporting. So their credit scoring is also improving. So there's also a large positive that's coming out of this encounter, even though I can't say, I have to admit that, yes, we have to address the negative so as to keep the industry sustainable. So I think the service that digital lenders are offering to the society at large is providing access to people who did not have financial access before. They may start at 500 shillings borrowing, and eventually, because I'm sure they will not stay there, for majority of them, eventually transitioning them into the mainstream formal sector, which maybe would have been difficult for them to access without this bridging that the digital lenders
Okay,
offer.
and as we, because time is not so much on our side, I just like us to do like a round of closing comments, but I'll sort of like pinpoint what I'd like you to address. Maybe for you, Derek, you can tell us as you close, this money that people are borrowing, especially through the apps, what is it being borrowed for?
I'll quote again the survey from 2017. And although I have to admit, I don't think I'm really one to judge to say what you're supposed to really borrow your money for. But I think there are a few aspects that you can look at and say this is not sustainable. Around 30-35% say they are borrowing for their businesses, which we can say is productive or a productive means of utilizing your loans. But there are also things you look at, you see another 30% saying they are borrowing for their day-to-day livelihood, to sustain themselves from the day-to-day. That means I'll borrow this month, pay back, borrow again next month. Now you see you're incurring costs, and this again is not sustainable.
So people borrowing more than they can handle?
Yes, and then there are others who are borrowing, around 10% borrowing to repay loans. Now that is where we go into the red. And then now there was also a unique factor where people say they are borrowing for betting. It's around 5%, but I think that was also interesting.
People are borrowing to bet because they feel it will bring them returns.
It will bring them returns.
Okay, and I just want to bring in Robert as we close also. How do I know that someone is not using my mobile phone? What are the security checks on your end, for instance? Because I know of someone who was unwell, and so when they were unwell, some relatives who had access to his phone took loans. So when he got to a place where he could actually get his phone, he's now paying loans which he has no idea, what security checks are there?
So identity theft is quite a big concern for us as well, because the moment we realize that you are not the real borrower, we have no option but to admit that it was a fraud, and we have to write it off. So the loss is on us. So obviously we try to take every measure possible. Now, part of what we do is when you apply for a loan, there are several authentication measures that we apply. We check your ID versus your actual phone number. We have access to the government IPRS system, which allows you to cross-check clients' details. In some cases where we are not certain, we work with the mobile telco to see if this user has registered more than one phone line. We check with CRB to see if there are other contacts details there, because then we can also contact you to verify. But last and most importantly, obviously, we want to make sure that you are the one. So on your phone itself, I think one of the things that that you have to be aware of, and one that will be driven also by the financial literacy drive that we are conducting, is just your own personal guard over your PIN, your own phone security, because now the phone has become an instrument of access to your, to your bank accounts and to your access to borrowing. So the user also has to take those measures, and for those we are using a lot of user literacy campaigns to educate. But on our side, we try to optimize and apply all the measures possible using the third-party partners such as CRB, telcos, and
this is usually, is this before you actually give out the loan, or is it when a suspected fraud case is brought to your attention?
No, it's before, because remember our service is expected to be online, real time, it's automated. So you have to build these checks in an automated fashion, because you have thousands of requests coming in. So you have to be able to request and only spit out or create the exceptions for those that don't fit and cannot be verified. And that's hopefully why you'll catch the frauds. But I have to say, having said that, despite applying all measures, we have a very high number. It is a concern for the entire industry, and it's something we're trying to address. And part of that is coming together as an industry to also increase the level of cross-checks that we can create, across the different service providers.
Okay, thank you. Now I want to bring in the lady, last but not least. And even as you close, what are the things that people need to look out for? By the time I'm going to take that loan on that app, if his app, I've got his app on my phone and I want to take that, what do I need to look out for to avoid being, one, listed, or two, being just caught up in some, because with online there's a lot of things you're seeing which, it's an emerging thing. You will see things that were never foreseen because it was never in existence. You don't find yourself in a situation that you become the guinea pig of the country that, this can happen to you. I saw it happen to someone, and then you are that someone. So what do people need to be on the lookout for?
Okay. Consumers need to really look at transparency. Before they take a loan, they must make sure that they understand the rate that or the costs of this loan, that it is disclosed, whether it is 7.5%, whether there is just a loan or there is a facility fee, the total cost of this loan. Because then you can make a decision whether it is worth you borrowing or not. Okay. The other thing is the security of their information. Let them make sure that they protect their data and their information. And then the other thing is they need to know that that loan has obligations. So you must make sure that before you take it, you understand whether it's a 30-day, 90-day facility, and that you're able to repay. If you are unable to repay within the time, make sure that you understand whether there is a way to contact that financial provider and see whether you can negotiate an extension or another payment plan. And if that happens, if there is a cost to that. So what I would advise consumers is to understand this is a contract they're entering into where they really need to understand the terms clearly. And when they default on a loan, they shouldn't sit back. They should know that may have certain consequences. So they should try to contact the service provider to be able to manage their default or the consequences of default. The other thing is to players in the industry, I think they need to continue ensuring there's a lot of transparency in the products they are offering. They are able to offer consumers more information about these facilities. And to the regulators, I think there's a good space now to regulate on certain aspects and the issues that are in the market. And I believe that now we are going to see tractions and policy and more research in this area so that we can come up with a balanced regulation that can assist the industry. Okay,
thank you very much. Unfortunately, time is not on our side. Definitely a conversation that needs to be carried on online, just in line with the apps and the likes, because it's something that affects many people. Like you said, there's 7 million people who are taking loans online, some of whom are now becoming famous on the CRB books, unfortunately, about 500,000 of them. And so be careful. You've had the advice you've been given and the guidance in regards to what you need to look out for, what you need to ensure you need to do before you can take that loan. And we're seeing a number of people who are taking loans to bet, and we've seen the social ills that have been brought about by betting in a number of cases. But nonetheless, we shall continue to follow up a lot of this and have this conversation online as well. Thank you for joining me. Phyllis Kamau is an advocate of the High Court, and she's a corporate, commercial and regulatory policy lawyer. We also have Robert Masinde, the country manager of Zenka Finance Kenya, and Derek Kiea, investments analyst at Saiton Investments. My name is Dan Mwangi. Thank you for joining us on NTV Today. NTV Sasa comes up in just a bit, and today they're speaking about endometriosis. That's Jane Goiri and Doreen Majala. Be sure to join the two ladies and the team after this. Have yourself a great late morning into afternoon.